Okay, let's unpack this. Today, we're embarking on a deep dive into something truly unique: the vast, ever-shifting landscape of global information, our mission, to conquer the fascinating challenge of making sense of it all.
Yeah, it's a lot to take in these days.
It really is. And we're going to tackle this by using prediction markets as our lens, specifically the daily snapshots from a platform called Kalshi. It's an incredible, almost real-time way to peer into what the collective mind is thinking about the future, often backed by real capital.
What's truly fascinating here, I think, is how these platforms capture that elusive wisdom of the crowd, right? They transform what might otherwise be pure speculation into, well, tangible probabilities that we can actually analyze systematically.
Exactly. It's not just polling.
No, not at all.
Yeah.
Kalshi isn't just a polling site, it's a dynamic marketplace where individuals can actually bet on the probability of future events, ranging from the intricacies of upcoming political nominations to, the unpredictable nature of daily weather patterns.
Other politics, finance. It's all in there.
It really is. It serves as a powerful, real-time aggregation of collective foresight. And in doing so, it offers some truly unparalleled insights into anticipated outcomes across a dizzying array of topics.
So our mission today is to extract the most important nuggets of knowledge from these daily snapshots, giving you, our listener, a clear and concise shortcut to being well-informed about what the collective is predicting. And just as importantly, we're going to explore where those predictions might get a little tangled, where the data itself presents some intriguing and sometimes quite stark inconsistencies.
Like weird bits.
Exactly. We're drawing all of this from the daily screenshots from Kalshi, specifically from June 16th and 17th, 2025, alongside a deeper analysis of the market insights and any identified internal contradictions that jumped out at us.
Indeed. And it's a remarkably rich source of information, offering not just raw predictions, but also a transparent window into where significant collective attention and, crucially, financial capital are being directed.
That's the key, isn't it? The capital.
The conviction of the crowd, as expressed through monetary commitment, is a powerful signal. It really is.
Yeah, here's where it gets really interesting. These markets aren't just about abstract predictions, they're about capital. People are literally putting their money where their collective mouths are.
They have skin in the game.
Right. And where capital flows, you often find a strong collective conviction, a perceived credibility in the market's forecast. It shows where people are willing to put their money on the line, indicating a level of belief beyond mere opinion.
Definitely.
But it also raises an interesting question. Does higher notional value always mean greater credibility, or could it sometimes just reflect the sheer number of casual participants in a popular market?
That's a key point to consider, absolutely. The notional value, sometimes referred to as total volume, invested in a particular market serves as a direct, quantifiable indicator of the level of interest and, crucially, the collective credibility participants assign to those predictions.
So bigger number, more credible, generally.
Generally, yes. Higher notional values suggest a more pronounced wisdom of the crowd effect, where significant capital is committed, implying greater collective confidence in the projected outcomes. However, as you rightly point out, sheer popularity can also drive volume, so it's a metric that always benefits from a deeper look at who is participating. Is it experts or just a lot of small bets?
Okay, good distinction. So let's dive into where this big money is actually flowing and see if the numbers tell a deeper story. What stands out most prominently in terms of where the capital is concentrating?
Well, starting with financial markets, the dominance is exceptional, almost staggering. Predictions related to major financial indices and commodities consistently show incredibly high notional values.
How high are we talking?
For instance, the market forecasting the S&P close price in 2025 alone commands over $39.8 million in committed capital.
Wow, nearly 40 million.
Yep. Similarly, the Nasdaq close price in 2025 market approaches a substantial $18.8 million. This isn't just a big number. It fundamentally underscores a powerful collective focus on macroeconomic trends.
So people are really betting big on the long-term economy.
It suggests that even in volatile times, the smart money believes there's a strong, identifiable trajectory for the broader economy, and they're willing to back that belief with substantial investment. What does this tell us about current investor psychology? Perhaps it reflects a flight to what's perceived as more stable long-term assets, or maybe a strong belief in fundamental economic recovery, as opposed to short-term speculative plays. It's quite telling.
That's a truly massive amount of capital just in the financial sector. It's not just about predicting the future, it's influencing investment strategies right now. What else is drawing this kind of astonishing financial attention? Anything surprising?
Surprisingly, yes. And I admit I had to double-check these numbers myself. Climate events are also attracting remarkably significant capital. We see exceptionally high volumes in climate-related predictions, especially for daily weather outcomes.
Daily weather, really? Like what temperature it'll be?
Exactly. The market for the highest temperature in NYC today on June 16th, for example, saw over $44.5 million in activity.
44 million. On the temperature in New York.
I know. Chicago's highest temperature market attracted over $37.8 million, and Austin's wasn't far behind with over $32 million.
That's just wild. Daily temperatures attracting tens of millions.
It is quite unexpected for daily weather, isn't it? It highlights a considerable financial interest, perhaps suggesting a growing perception of the immediate financial and societal impact of climate events, even on a day-to-day basis.
So it's not just long-term climate change, it's the now.
It seems that way. It makes you wonder if people are literally just betting on the weather, like a casual thing, or if this indicates a more sophisticated market for climate-related financial products emerging. Hedging risks, maybe?
Yeah.
It's a fascinating signal, whatever the reason.
Truly astonishing. It paints a picture of how climate is increasingly intertwined with economic considerations, even moment to moment. Okay, shifting gears slightly, let's look at the broader economy. What do these markets predict for economic indicators beyond just daily temperature fluctuations?
Well, economic indicators are, predictably, also very closely watched, with substantial notional values. Inflation in June, CPI-EOY, that's the Consumer Price Index year over year, accumulated $16.2 million.
Okay, still big numbers.
Definitely. Gas prices in the U.S. this month reached $15.1 million, and the broader CPI in June had $9.5 million. These figures reflect a palpable widespread concern and intense prediction activity surrounding economic stability and performance.
Makes sense. People feel those directly.
Exactly. It indicates that participants are actively trying to foresee and capitalize on economic shifts that affect everyone's daily lives and long-term financial planning. These aren't abstract numbers to them.
And what about the other major areas like politics and technology? Do they compete with the financial and climate behemoths in terms of capital flow, or are they playing in a different league entirely?
They're significant, but generally on a different scale compared to the financial and climate behemoths. Major political races, such as the Democratic nominee in 2028, gathered $6.5 million.
Still millions, but not tens of millions.
Right. And the NYC mayor race involving Andrew Cuomo saw $4.5 million in invested capital. In the technology sector, the best AI this month market, specifically for Gemini, was prominent with over $5.7 million.
So still important, just not the same massive scale.
Exactly. These values, while lower than the top financial and climate markets, still denote considerable attention and capital commitment, indicating their importance within the collective consciousness of the market. They might not move tens of millions for a daily temperature, but they represent significant conviction for events with broader societal impact.
Okay, so what does this initial heat map of capital flow tell us? For you, the listener, it's a direct indicator of where the collective's confidence, and indeed their money, is most heavily invested, highlighting areas where future events are most likely to unfold as predicted, or at least where the market perceives the clearest signals.
Yeah, it's like a map of conviction.
It's like looking at a strategic map of future probabilities driven by actual capital. If you're finding these insights valuable, folks, drop a like and share this deep dive with someone else who loves being well-informed. Okay, having set the stage with where the collective capital is flowing, let's now peel back the layers and examine some of the specific predictions that are truly shaping our understanding of the future. Let's start with the ever unpredictable world of politics, where even a single day can reveal significant shifts.
Right.
We've got data from both June 16th and June 17th, which is great because it allows us to see how probabilities change day over day, offering a glimpse into shifting sentiment.
Indeed. And starting with the NYC mayoral race, the June 16th data showed Andrew Cuomo with a 60% probability of being the Democratic NYC mayor nominee against Zohran Mamdani at 39%.
Okay, Cuomo leading there.
Yeah, and the market also predicted Cuomo's first-round margin of victory with a 50% chance of being 5% or less and a 30% chance of being between 5.01 and 10%. So potentially a close race.
But there was a wrinkle, right, for Manhattan specifically.
Yes. A critical contradictory view emerged specifically for Manhattan. A separate market indicated Zohran Mamdani at a surprisingly high 74% to win Manhattan in the 2025 NYC Democratic mayoral primary versus Andrew Cuomo at 34%.
Wow, 74% from Mamdani in Manhattan, but Cuomo leading overall.
Exactly. This clearly highlights a significant regional split in support. A candidate can lead overall but face strong, localized challenges in specific areas or boroughs, which could seriously complicate a general election strategy.
Absolutely. And how did that evolve by June 17th? Did we see a significant shift in sentiment, or did the market double down on its earlier predictions?
Well, by June 17th, Andrew Cuomo's probability as the Democratic NYC mayor nominee had notably shifted upwards to 72%, while Zohran Mamdani's dipped to 27%.
That 12% jump for Cuomo in 24 hours, that's huge.
It is quite significant, yeah.
Mm-hmm.
Suggests either a major news event broke or maybe just a consolidation of sentiment as the market gained more clarity or information. The expected margin of victory for Cuomo also saw slight changes, with a 43% chance of 5% or less and a 37% chance of 5.0110%, still pointing towards potentially close.
And there was a new market on the 17th?
Yes, what's new on June 17th is a broader market for the NYC mayoral race winner overall. That gave the Democratic candidate an overwhelming 90% likelihood of winning the general election, compared to the Republican candidate at a mere 5%.
90%. So the primary is seen as the real race there.
Pretty much. These day-over-day changes imply a fluid political landscape and highlight how quickly market probabilities can adjust to perceived shifts in public opinion or new information entering the public domain. It's fascinating to watch in near real time.
Definitely. Okay, shifting gears to international politics and events. What are the markets predicting for key global players and future diplomatic movements, particularly concerning major figures like, say, a potential future President Trump?
Right, so for international visits by Trump in his first year, France was seen as most likely at 58%, followed closely by India at 52%.
Okay, traditional allies and major powers.
The probability of the U.S. taking control of any part of Greenland remained quite low at 23%, so the market isn't really buying that one happening anytime soon.
Probably wise.
And a rather specific and perhaps telling prediction, the likelihood of Trump recognizing Pride Month was only 8%.
Only 8%. Wow, that's a stark reflection of collective sentiment right there.
It is. Looking at June 17th data, the market also gave a 43% chance of a new U.S.-Iran nuclear deal being signed this year. So not impossible, but less than a coin flip.
Interesting. And who might Trump meet first?
As for who Trump will meet with before July 2025, Benjamin Netanyahu had a 43% probability, significantly higher than Volodymyr Zelensky at 21%.
So priorities seem clear in the market's eyes there.
These probabilities offer a fascinating snapshot of anticipated geopolitical movements, key diplomatic engagements, and how the market perceives the likelihood of certain policy stances from a potential future administration. It's like reading tea leaves, but with millions of dollars behind them.
Okay, now let's jump into the wild world of crypto. This is a sector known for its rapid volatility, but also for strong, sometimes even fervent predictions. What's the collective wisdom telling us about Bitcoin and other digital assets? Are we looking at a sustained bull run or something more cautious?
The sentiment around Bitcoin is fiercely bullish across both days, indicating a strong collective belief in its continued upward trajectory.
Fiercely bullish. Give us the numbers.
On June 16th, there was a robust 63% probability of Bitcoin reaching $125,000 or above this year. That dipped slightly to 61% on June 17th, but still very high.
125K and higher.
Yet the probability of hitting $150,000 or above this year was 32% on June 16th, actually increasing a bit to 34% on June 17th.
So still a decent chance of 150K this year.
Seems so. Additionally, there was a 35% chance of Bitcoin reaching $150,000 before 2026, and a 22% chance of hitting it before October on June 16th, which adjusted down a bit to 17% before October on June 17th. So maybe a slight cooling on the very near-term massive jump.
Okay, but what about the downside? Is there a floor?
Well, conversely, the probability of Bitcoin falling below $70,000 this year was relatively low at 23%. And even lower for below $60,000 at just 14% on both days.
So the market really doesn't see it crashing hard.
It seems not. This clearly indicates a prevailing and powerful bullish sentiment, likely driven by factors like increasing institutional adoption, anticipation of further supply shocks post-halving events, or just a broader belief in cryptocurrency as a store of value.
Right, the usual suspects. So generally the market is expecting Bitcoin to go up, and significantly so, with a pretty clear floor established. What about Ethereum, the second largest cryptocurrency, and the broader regulatory landscape for digital assets? That's always a big question mark.
Yeah, Ethereum is predicted to reach $4,000 or above this year, with a consistent 39% probability across both June 16th and 17th. So, bullish, but maybe not as wildly as Bitcoin?
Still, $4K is a significant target.
Definitely. And a significant trend to watch, which could impact all digital assets, is federal crypto regulation. This carried a high probability of 73% this year on June 16th, slightly moderating to 65% on June 17th.
Still over 60% chance of regulation this year.
Right. This reflects a growing and sustained expectation of a more structured regulatory environment for digital assets, which, many believe is a necessary step for broader mainstream adoption, even if it causes short-term volatility.
True. And XRP, you mentioned something interesting there earlier.
Yes, XRP shows a high probability of 80% of being $3.05 or above this year, based on June 17th data. Keep that 80% number in mind, though, because we'll definitely need to touch on a fascinating contradiction regarding this later in our discussion. It's a really weird one.
Okay, noted. 80% for $3.05 or above. Got it. And Dogecoin, the meme coin favorite that often surprises analysts, are there any specific price predictions for it, or does it remain as unpredictable as ever?
Well, for Dogecoin's price at 5 p.m. EDT, June 16th data showed a 39% chance for $1.18 or above, and also a 39% chance for $1.07 or above. Kind of wide range there.
Yeah, 18 cents or 7 cents, big difference. What about the 17th?
By June 17th, the probability shifted, becoming a bit more consolidated maybe. 46% for 41.75 or above, and 39% for $1.17 or above. The June 17th data also offered a specific price range, 38% for 17 cents, $1 to 749.99.
So still volatile, but maybe homing in on that 17-cent mark.
Seems like it. So while still volatile, the market seems to be narrowing in on a range, at least for that specific snapshot. Other crypto markets being watched include Coinbase volume, the potential creation of a national Bitcoin reserve, and whether Bank of America will launch its own stablecoin, all signaling increasing integration of crypto into traditional financial systems.
Okay, lots happening in crypto as always. Let's transition back to climate, an area where, as we discussed earlier, significant capital is flowing. This isn't just about abstract climate models anymore. It's about tangible, daily impacts. How precise are these temperature predictions for major U.S. cities, and are we seeing any interesting shifts day to day?
The markets are surprisingly precise, actually, offering tight ranges for daily temperatures, showing how granular these predictions can become. It's quite impressive.
Give us some examples. Chicago.
Okay, for Chicago, June 16th predicted 86, 87 degrees Fahrenheit at 47% and 88 degrees or higher at 31%. By June 17th, this shifted slightly. 86, 87 degrees dropped to 36%, but 88 degrees plus increased to 37%. So suggesting a slightly hotter overall outlook as the day progressed.
Interesting. What about L.A.?
In L.A., June 16th had 75, 76 degrees at 62% and 73, 74 degrees at 23%. June 17th saw a change to 75, 76 degrees dropping to 45% and 77, 78 degrees jumping up to 32%, indicating a general warming trend there too.
And New York. We saw massive money there.
Yeah, NYC also saw a noticeable shift. June 16th projected 66, 67 degrees at 43% and 68, 69 degrees at 32%. But June 17th moved towards warmer ranges, with 73, 74 degrees at 35% and 71, 72 degrees at 35%. That's a clear warming trend over just one day in some major cities, reflecting immediate atmospheric changes or maybe just refined forecasts.
That's a clear and consistent warming trend for several major cities in just 24 hours. What about others, especially those known for more extreme weather, like Austin or Denver, and how dynamic are those predictions?
Right. Austin on June 16th showed 95, 96 degrees at 40% and 97, 98 degrees at 33%. Hot stuff. The next day, June 17th, shifted slightly to 94, 95 degrees at 36% and 96, 97 degrees at 32%, indicating a slight downward adjustment in the highest heat probability. Maybe a recognition of local conditions changing, like cloud cover or something.
Oh, okay, slight cool down predicted there. Denver.
Denver saw a dramatic shift, really dramatic.
Yeah.
June 16th had 92, 93 degrees at 36% and 94, 95 degrees at 29%, forecasting very high temperatures. However, on June 17th, the probabilities completely flipped. 76 degrees or below shot up to 76% probability, and 77, 78 degrees was only 22%.
Whoa, from mid-90s likely to mid-70s likely. That's a massive change.
It really is. Suggests a much cooler day than initially predicted. This highlights the inherent unpredictability of local weather, even on a daily basis, and how quickly markets react.
No kidding. What about Miami and Philly?
Miami remained consistently hot, not much surprise there. June 16th was 89.90 degrees for 68% and 91.92 for 27%. It shifted slightly to 90.91 at 64% and 88.89 to 33% on June 17th. Still hot and humid, basically. Philadelphia also saw a noticeable warming shift from 69.70 degrees at 46% on June 16th up to 78.79 degrees at 43% on June 17th.
Another big jump for Philly.
Yeah, and the lower band shifted too from 67.68 at 30% up to 76.77 at 31%. These day-to-day shifts really underscore the dynamic nature of weather predictions in these markets and how quickly sentiment, or maybe just the underlying weather models, can pivot.
Absolutely. So beyond these daily temperatures, what about broader seasonal weather trends? Are we heading for an active hurricane season or a particularly hot year globally? The markets are putting money on these macro climate predictions too, right?
They are. And the market suggests a strong likelihood of an early hurricane season. There was a 53% probability of the next hurricane forming before July 15, 2025, increasing to 83% before August 1, 2025, on both days.
83% chance before August 1st, that's really high.
It indicates a very high conviction from the market that tropical storm activity will pick up swiftly this year. For June temperature increase globally, there was a 56% chance of a 1.03–1.09 degree rise on June 16th, which climbed to 66% on June 17th, reinforcing the expectation of warmer June, perhaps impacting things like agricultural yields or energy consumption.
Okay, warmer June expected. What about tornadoes?
The number of tornadoes this month showed an interesting shift. On June 16th, above 225 tornadoes had 49% probability, and above 250 had 30%. By June 17th, above 225 was down to 41%, but above 250 had increased significantly to 41%.
So a shift towards predicting a higher number of tornadoes, even if the lower threshold probability dropped.
Exactly. It indicates a higher probability being assigned to more severe and frequent tornado activity as the month progresses. Interestingly, though, despite all these specific warming trends and storm predictions, the probability of 2025 being the hottest year ever was only 11% on June 17th.
Only 11%? That seems low given everything else.
It does, yeah. It suggests the market doesn't foresee a global record being broken this year, even if individual regions experience higher temperatures or more storms, maybe comparing against already very hot recent years.
Fascinating. These granular predictions about daily weather and seasonal climate give you a real sense of what to expect and how the markets are pricing in environmental factors. It's truly a fascinating intersection of economics, meteorology, and human perception of risk.
It really is.
And folks, to go even deeper into these fascinating market insights, make sure to subscribe to the YouTube channel. We're constantly breaking down complex data like this into actionable knowledge.
Definitely worth checking out.
Okay, moving on, let's talk about the world of companies and the cutting edge of science and technology. This is where innovation meets investor confidence and where we get a glimpse into the future of enterprise and scientific breakthroughs that could truly reshape our lives.
Absolutely. In a companies category, AI dominance is a very clear and consistent theme, reflecting the current landscape of technological competition, as you'd expect.
Who's winning the AI race, according to Kalshi?
Well, for best AI this month, Gemini was the overwhelming favorite, predicted at 92% on June 16th, slightly dipping, but still commanding a formidable 88% on June 17th.
92%, that's almost total consensus.
Pretty much. Its closest competitor, ChatGPT, lagged far behind at a mere 6% on June 16th, and Grok came in at 4% on June 17th. This indicates an almost universal consensus among market participants regarding Gemini's current lead in the AI space and how quickly these market sentiments can consolidate around a perceived leader.
Very clear signal there. And what about Tesla, a company notorious for its ambitious goals and often polarizing predictions? Are the markets bullish on their targets for, say, robo-taxis or production numbers?
Oh, very much so.
Yeah.
Tesla's robotaxi release this year held a high likelihood of 82% on June 16th, slightly decreasing, but still high at 80% on June 17th.
80% chance of robo-taxis this year. That's bold.
It suggests strong market belief in the company's ability to achieve this groundbreaking innovation soon, reflecting a significant amount of capital placed on that particular outcome. For production this quarter, there was a robust 94% chance of being above 350,000 units on June 16th.
94% above 350K.
Yeah, and an impressive 58% chance of being above 410,000 units on June 17th. So, raising the bar. Deliveries for the quarter were also predicted to be strong, with a 77% chance of being above 350,000 units on June 16th, maintaining a 74% chance on June 17th.
So the market really believes Tesla can deliver, literally.
These probabilities reflect the market's robust confidence in Tesla's operational capacity and ability to meet its ambitious output targets, despite the challenges of scaling production that they always seem to face.
True. Any other interesting company insights? Netflix, Palantir.
Yeah, other company insights being actively traded include predictions for Netflix earnings, especially looking at churn versus the success of their ad-supported models. Also, Palantir's strategic moves, the DRIP, as they call it, and its continued government contracts. And Google's earnings, particularly navigating the ongoing battle between privacy concerns and regulatory pressure. Lots of moving parts there.
Okay, shifting to broader financial markets now, beyond individual companies. What's the collective outlook on major indices like the S&P 500, critical commodities like oil prices, and overall economic health indicators like GDP and unemployment?
Right, the S&P 500 is largely predicted to finish 2025 positively. There was a 75% probability on June 16th and still a strong 70% on June 17th. So general market optimism about continued growth seems to be the baseline.
Okay, positive outlook for the market overall. Oil prices.
WTI oil is also expected to maintain high prices, with an 83% probability of being $90.01 or above by year-end on both days. That reflects expectations of sustained demand or perhaps limited supply, keeping prices elevated.
83% chance of oil over $90. That's significant. GDP.
For U.S. GDP growth in Q2 2025, there was a 75% probability of being above 2.5% on June 16th, and a high 63% probability of being above 3.0% on June 17th. So again, indicating optimism about continued economic expansion in the near term.
But what about jobs, unemployment?
The unemployment rate in June showed some mixed signals, maybe a bit more caution there. There's a 63% chance of being above 4.2% on June 16th, softening slightly to 55% on June 17th.
So a bit less certainty about unemployment staying super high.
Yeah, it suggests a subtle shift in expectations regarding the labor market, perhaps anticipating a slight easing of tightness or maybe just more uncertainty creeping in.
And the wealthiest person in the world, race a perennial favorite for headlines. Any surprises there? Or is the market's conviction as strong as a frontrunner's fortune?
No surprises at all there. Elon Musk is overwhelmingly expected to be the wealthiest person this year, with an 86% probability on June 16th, remaining very high at 81% on June 17th.
81%. That's incredible confidence.
It is an incredible level of confidence in one individual's financial trajectory. Mark Zuckerberg lags far behind, with only a 9% chance on June 16th and 8% on June 17th. So, yeah, pretty much a one-horse race in the market's view.
Okay. And inflation. And the Fed. Big topic.
That's right. In terms of inflation, CPI-YoY, that's the Consumer Price Index year over year in June, was predicted to be above 2.5% with a 72% probability on June 16th, a figure that remained consistent at 71% on June 17th.
So inflation staying above that 2.5% mark is likely.
Very likely, according to the market. The probability for it being above 2.6% was 39% on June 16th and 40% on June 17th, indicating a persistent expectation of elevated inflation. Maybe not runaway, but definitely elevated.
And the Fed's response. Interest rates.
Lastly, the Fed funds rate in July is predicted to be above 4.25% with 85% probability and above 4.00% with 95% probability, according to June 17th data.
Wow, 95% chance rates stay above 4%.
Yeah. This indicates the market overwhelmingly expects interest rates to remain elevated, which of course affects borrowing costs and investment decisions across the entire economy. No cuts imminent, according to this.
Fascinating. Okay, now let's dive into science and tech, looking at the long-term trends and groundbreaking innovations that the markets are eyeing. This isn't just about what's happening now, but what's anticipated to reshape our future, maybe years down the line.
Exactly. Beyond the immediate AI competition we discussed, the market has strong convictions about Tesla's autonomous driving capabilities.
Yeah.
There's a significant 77% chance of launching unsupervised full self-driving, or FSD, before 2026.
Unsupervised FSD before 2026. That's still a huge bet.
It reflects immense belief, or maybe hope, in Tesla's ability to achieve true autonomy relatively soon. In the realm of space, there's a 68% probability of 2 SpaceX Starships being together before 2028.
2 starships together. Docking. Or just in orbit.
The market doesn't specify, but it showcases anticipation for significant milestones in space exploration and perhaps even multi-ship missions or refueling operations. For SpaceX Starship's 10th launch specifically, there was a 48% chance before July 06, from 23% before June 28 on June 16th, showing the market's close tracking of launch schedules and potential delays.
Right, always watching those launch windows. What about other AI players?
XAI, another Elon Musk venture, has a 63% likelihood of releasing Grok 4 this year, another sign of the rapid AI development happening across multiple companies.
And looking further ahead, the big one, AGI.
Looking further ahead, OpenAI's AGI, or Artificial General Intelligence, is given a 54% probability before 2030 and, interestingly, 48% before 2026, according to June 17th data.
Almost a 50% chance of AGI before 2026? That seems incredibly optimistic.
It does, yeah. Reflects the market's assessment, or maybe the hype cycle, of when humanity might reach truly transformative AI. And a more immediate prediction. ChatGPT-5 is overwhelmingly expected to be revealed this year, with an 89% probability on June 17th.
Okay, GPT-5 this year seems almost certain then.
According to the market, yes, signaling the rapid pace of iteration in the large language model space. These predictions really highlight the rapid pace of innovation and the collective expectation for major technological advancements in the coming years, some perhaps sooner than we think.
It really does. If you're thinking about investing or just tracking the cutting edge of human ingenuity, these market insights give you a pulse on what the collective wisdom sees coming next. They offer a unique perspective on which innovations are likely to stick and truly reshape our world, moving beyond just hype.
Filtering the signal from the noise.
Exactly. For daily updates and deeper dives into the markets, folks, make sure you're following us on Twitter at Valify.
Good place for quick hits.
Okay, beyond the domestic headlines and company news, the markets also weigh in heavily on global affairs. Geopolitical shifts are constantly in motion, and prediction markets give us a unique window into how the collective is assessing international relations and potential worldwide economic shifts that could have far-reaching consequences.
Indeed. In international relations, the market on June 16th predicted a 26% chance that Israel and Syria would normalize relations this year. That figure remained nearly identical at 24% on June 17th.
So unlikely, but not impossible, basically.
Yeah, right. It suggests the market sees a low but persistent probability for a significant diplomatic breakthrough in a historically complex region. A more optimistic outlook existed for Israel and Saudi Arabia, normalizing relations during Trump's term, with a 51% probability on June 16th.
51%, so basically a coin flip on that one.
Pretty much. By June 17th, the focus shifted slightly, with a 24% chance of Israel and Qatar normalizing relations during Trump's term, so less likely than the Saudi deal. These nuanced probabilities offer a snapshot of the collective's expectations for significant diplomatic breakthroughs in a region constantly in flux.
Very interesting nuances there. And what about broader geopolitical and economic shifts around the world? Things like national policy decisions or the specter of recessions in major economies. How are those playing out in the markets?
Well, the market sees a notable 66% probability that the president will pull federal funding from California universities. That was a consistent prediction across both June 16th and 17th.
66%, that's a significant policy expectation with potentially huge impact.
Absolutely. Looking at economic stability in Europe, Germany has a 48% chance, and the United Kingdom a 59% chance of experiencing a recession. Those figures held steady across both days.
So UK more likely than Germany hit recession, but both are pretty high risks.
Yeah, it suggests the market is pricing in a considerable but not definitive risk of economic downturns in key European economies. The prospect of Argentina dollarizing its economy before 2026 was quite low at 9% on June 16th, though again, we'll definitely discuss an interesting nuance with that data point very soon. It's another weird one.
Okay, Argentina dollarization low, but with a caveat. Got it. What else? EU, Scotland.
The probability of the EU losing a member before 2030 remained steady at 38% on both days. So, a possibility, but not the base case. A Scottish referendum being called before 2027 held a lower 15% probability.
So Sexit's not seen as likely soon?
Not particularly. Lastly, a ban on Harvard accepting international students by the end of this year showed an 81% probability on June 16th, slightly dipping to 75% on June 17th.
Still, 75% chance of Harvard banning internationals. That seems extreme.
It does seem high, yes. These predictions give us a sense of the collective's expectations for significant international developments, from regional conflicts to potential economic downturns and national policy shifts that could affect global education and migration patterns.
These global predictions really offer a window into the collective's expectations for significant international developments, from regional conflicts to economic stability. It's like a geopolitical crystal ball, isn't it? Albeit one that's constantly being updated by real-world sentiment and the financial commitments of thousands of participants.
Yeah, a crowd-sourced crystal ball.
But here's where it gets really interesting and frankly a little tricky. While prediction markets are powerful tools that aggregate incredible amounts of information, the data itself sometimes contains fascinating internal contradictions.
Right, the cracks in the crystal ball.
Exactly. It's not about one side countering another or a matter of opinion, but about inconsistencies within the data itself that force us to be more critical in our interpretation. It's a reminder that even the wisdom of the crowd needs careful scrutiny.
Absolutely. And these are critical nuances that highlight the need for careful scrutiny and just a logical approach to data interpretation. Let's go through some of these internal logical inconsistencies, primarily identified in the June 16th data, though some, disturbingly, persisted into the June 17th snapshots, which is quite surprising.
Okay, lay them out for us. What's the first one?
First, consider Trump's Mar-a-Lago visits. The data indicates a 95% probability for 0 visits this month, and a 12% probability for 1 visit this month.
Wait, 95% for 0 visits, 12% for 1 visit in the same month.
Exactly. Now, think about that for a moment. These are mutually exclusive events. He can't make 0 visits and 1 visit simultaneously within the same month.
Right, it's either one or the other, or more, but not both 0 and 1.
Precisely. When you add those probabilities together, they sum up to 107%, which is logically impossible for discrete, non-overlapping outcomes. This points to a clear inconsistency in how the market priced or presented these events. It's a fundamental statistical problem where the probabilities simply don't add up correctly for a set of defined exclusive choices. The total should be a 100% or less if other outcomes are possible.
Okay, that's a fundamental statistical problem right there. If the choice is either 0 or 1, or maybe more, then those probabilities should sum to 100%, not 107%. What's another glaring example of this?
Next up, and this one is quite stark, remember the XRP price prediction we flagged?
Yeah, 80% for $3.50, right?
Right. On June 16th, the data showed that 80% probability for XRP being $3.05 or above this year, but only a 31% probability for it being $3.04 or above this year.
Hold on. 80% chance to be above $3.50, but only 31% chance to be above $3.40. That makes no sense.
It's a direct logical contradiction. Any price that is at or above $3.05 must also, by definition, be at or above $3.04. Therefore, the probability for $3.04 or above should always be greater than or equal to the probability for $3.05 or above.
That has to be.
The persistence of this specific contradiction, as shown in the June 17th data where $3.04 or above is still way lower than $3.05 or above, 72% pounds, 80% respectively, makes it even more striking. It suggests significant mispricing or a data error that hasn't been corrected by the market or the platform itself. It fundamentally undermines the reliability of those particular price points. You just can't trust them.
That's a massive red flag for anyone trying to interpret that data or use it for investment decisions, just completely illogical. What about climate predictions? We saw a lot of capital flowing there, so one would hope for more internal consistency. Did we find any issues?
Indeed, you'd hope so. But the rain in NYC this month market presents another oddity. The data states an 85% probability for above 2 inches of rain, and indeed an 85% probability for above 3 inches of rain.
Okay, 85% for above 2 inches, 85% for above 3 inches. What's wrong with that?
Logically, if it rains above 3 inches, it must also rain above 2 inches.
Right. More than 3 is definitely more than 2.
So the probability for above 2 inches should be equal to or higher than for above 3 inches. Having them both at 85% is highly improbable unless the question for above 2 inches implicitly means between 2 and 3 inches, which would be incredibly imprecise phrasing for a prediction market.
Yeah, that would be weird phrasing.
Or it's just a clear data error in how these ranges are defined or calculated, leading to overlapping but nonsensical probabilities. It sounds like imprecise language or a misunderstanding of how these cumulative probabilities interact.
It certainly does. Sloppy question design, maybe? What about the S&P 500? That's a key financial indicator where even small inconsistencies can have large implications for traders.
Right. For the S&P 500 all-time high, the data shows the probability for it to hit a new all-time high before August 2025 is 73%, while the probability for hitting it before August 2025 is 69%.
Wait, more likely to happen by August than by October? How does that work?
Exactly. It doesn't. This is contradictory. If an event is likely to happen by an earlier date, in this case August, it should be at least as likely, if not more likely, to happen by a later date, such as October, because the later time frame includes the earlier one.
Of course. The October window contains the August window.
So the probability for the longer period should logically be equal to or higher than for the shorter period. This one really jumps out. It feels like a simple oversight in how the date-based probabilities were recorded or derived, but it's a fundamental flaw in temporal logic.
That's a fundamental flaw in temporal logic, yeah. Anything else in the app space? We briefly touched on the runner-up app earlier. You mentioned a conflict.
Yes, the runner-up U.S. iPhone app market presents a direct internal conflict. In the company's section of the data, Love Island USA is listed as the runner-up at 83%, with Threads at 15%.
Okay, Love Island runner-up, Threads third, basically.
But then in the science and tech section, Love Island USA is still at 83%, but ChatGPT is now listed as the runner-up at 12%.
So which is it? Threads or ChatGPT as the runner-up to Love Island?
Exactly. It's a direct contradiction regarding which app is considered the runner-up. It clearly implies either two different market questions with the same label being presented in different sections, or a fundamental inconsistency in the underlying data classification or entry. It makes it impossible to ascertain a clear runner-up from this data without further clarification.
Just messy data handling, it seems. And we also saw some interesting temporal contradictions in the world section, similar to the S&P example, right? Argentina and Musk.
Precisely. Remember, Argentina dollarizing. For when will Argentina dollarize its economy? The probability is 9% before 2026, but it's 13% before August 2025.
Higher chance before August this year than before 2026. Again, backwards.
Yep. Similarly for will Musk support the Republican spending bill, because it's 23% before September 2025, but 13% before August 2025.
Lower chance for the shorter time frame this time. Still makes no sense.
In both cases, the probability for an event occurring by an earlier date is different from the later, broader time frame in a way that defies logic. A broader time frame must encompass and thus have a probability equal to or greater than a narrower, earlier time frame nested within it. These temporal fallacies suggest issues with how the market either frames its questions or processes the aggregated predictions over varying time horizons.
More evidence of potential flaws in the market design or data processing? And finally, what about that AI market listing we saw? It looked like a typo, but even typos can create ambiguity, right?
That's right. The top AI model this month, data, lists Gemini 2.5 Pro at 57% and something called Gemini 2.5 Pre at 1%.
Gemini 2.5 Pre-dash, what is that?
Exactly. The term pre is almost certainly a typographical error in the source data. It likely refers to a different version or stage of Gemini, maybe preview, or perhaps it's simply a mistyped Pro. While not a logical contradiction in the same way as the others, this is a data ambiguity that makes it harder to interpret precisely what Gemini 2.5 Pre refers to.
So it muddies the water?
It does. It highlights how even small data entry errors or poorly structured market options can introduce fuzziness into the collective signal these platforms aim to provide, making it challenging for participants and analysts alike to know exactly what's being bet on.
Okay, this raises an important question then. What do all these inconsistencies tell us? They aren't counter data in the sense of an opposing viewpoint, right? There's something else.
Exactly. They highlight the critical need for critical thinking when interpreting crowdsourced data, and they point to potential flaws in the data's internal coherence or maybe just the phrasing of the original questions on the platform itself.
So it's about the data's integrity, not just differing opinions.
Precisely. It reminds us that even with the wisdom of the crowd, the underlying structure and presentation of the data matter immensely. These are not opinions trying to counter the data. They are the data, revealing inherent flaws in its construction or collection and underscoring the importance of logical consistency.
Absolutely crucial point. If this detailed breakdown of data and its occasional weirdness sparks your curiosity, folks, drop a like and share this deep dive. Your support helps us continue to provide these in-depth analyses.
It's important work.
So what does this all mean, wrapping up our journey through the collective predictions of a diverse range of events from the Kalshi platform? It's been a fascinating snapshot of current expectations, and despite some quirks, it feels incredibly valuable for understanding where the collective consciousness believes the future is headed.
I agree. To reiterate, prediction markets like Kalshi provide a truly fascinating snapshot of collective expectations. The exceptionally high notional values we observed in financial, climate, and economic markets strongly suggest significant interest and a high degree of confidence from participants in those particular predictions.
That's where the big money feels surest.
Yeah. This indicates where the market believes its predictive power is strongest, essentially where the smart money is putting its conviction, offering real-time insights into perceived future trends.
But as we've clearly seen, it's not without its complexities and not without its need for a discerning eye, right? Those contradictions are pretty jarring.
Precisely. The identified internal contradictions serve as a crucial reminder that data, even that generated by the wisdom of the crowd, must be rigorously scrutinized for full accuracy and logical consistency. These aren't minor glitches. They can fundamentally alter the interpretation of the probabilities presented.
You can't just take the numbers at face value.
No. If we connect this to the bigger picture, it's about being informed but also being discerning. It's about understanding not just what is predicted, but why it matters, and crucially, where to question the data itself.
Critical thinking is key.
Absolutely. Ultimately, knowledge is most valuable when it's not just passively consumed, but actively understood and applied. And being able to spot these inconsistencies is a key part of truly understanding the information and its limitations in this, age of information overload.
Well said. This deep dive isn't just about giving you facts. It's about giving you the tools to analyze information, even when it seems contradictory, and to understand the implications for your world. It's about cultivating that critical thinking muscle that's so essential in our information-rich environment.
Exactly.
For more exclusive content and a deeper look into how prediction markets can help us understand future trends, folks, subscribe to the YouTube channel. And that leaves us with one final thought for you to mull over. If the collective consciousness, as expressed through these powerful prediction markets, is so accurate on so many things, commanding tens of millions in capital for daily temperatures and projecting clear future trends, what does it truly mean when its own internal data contains fundamental logical contradictions?
Yeah, what does that mean?
Does it suggest a fundamental limit to crowd wisdom, maybe?
No.
Or simply a need for sharper analytical tools and a more robust design for these fascinating platforms as they continue to evolve? Something to think about.
Definitely food for thought.
Follow us on Twitter at Valley5 for even more updates and behind-the-scenes insights into our next deep dives. We love hearing from you.